Hello and welcome back to the channel. In this series of videos, I'm going to show you everything you need to know to start investing in the stock market and how to set up yourself for success using rules. You can check out the breakdown in the description below if you want to skip ahead to a specific section. This video is for informational purposes only and is not a recommendation, just my personal opinions. With that, let's get into it. I'm going to touch on a bunch of important questions like, how much money do you need to start investing? Is $100 enough? What is a stock? And which ones do I pick? Why do I need bonds? What type of investor should I be? Should I take an active or hands-free approach? What is asset allocation? What are strategies that investors use? Why is diversification so important? How many assets should you limit your portfolio to? And why is that important? What brokerage should you use? And what should you watch out for? In another video, I'm going to talk about how to research stocks. I'm going to touch upon the differences between fundamental and technical analysis. I'm going to try to cover as much information as I can in this video. And if you have any additional questions for me at the end of this video, please ask them in the comments below. Later in the video, I will discuss my process and rules when making investment decisions. I want to help you see that investing for the long term doesn't have to be complex. I want to be as transparent as possible by showing you my process and how you can grow your portfolio by following simple rules. Creating rules removes emotion and allows you to focus on achieving your financial goals. Our first rule is to determine your risk capacity for the goals you're trying to reach. Define your goals and your time horizon for meeting those goals. Are you saving for your child's college fund or maybe retirement? Is the end date your child's 18th birthday or when you turn 65? Your risk capacity is the amount of risk you can take without needing to change your investment goals in the time you have available. Take a moment and ask yourself the following questions. If you lose your money investing today, will you have time to make up any losses before you need that money? And will you still be able to reach all your savings goals? If a financial emergency occurs, will it not require you to tap into your investments early? If you answer no to either of those questions, you may need to reevaluate your investment goals as your current time horizon doesn't fit your risk capacity. The greater your time horizon, the more risk you can take as you have more time to recover. The less time you have to recover, the less risk you can take. The data shows that when you're saving for a goal that is less than 3 years away, your best bet is to just stay in cash as your risk capacity is shallow. Don't invest money that you can't afford to lose. Everyone's financial situation is different. Only you or a licensed financial advisor can define your financial goals. All investments involve some degree of risk. You are the only one who can make this choice. Rule number 2 is to start early and pay yourself first. Compounding growth requires two things: time and contributions. We defined our time horizon in rule number 1 so that we can have a clear view of our expectations. The next step is automatically taking a percentage of what we earn and invest it so we never see it as money we can spend. How much can you set aside before spending anything on your living expenses? Most people fail to take advantage of the power of compounding, the multiplying power of growth times growth. Let's take a look at compounding in action. We have two friends, Nina and Mark. They both are able to save $28 a week or $1,456 a year. But Nina is able to start earlier at the age of 20 while Mark starts at 30. They will both need to start tapping into their investments at the age of 60. To keep things simple, both of their investment portfolios provide an annual return of 10%. The thing is, Nina can only contribute to her portfolio for the first 10 years, while Mark is able to contribute to his portfolio at the beginning of each year until the age of 60. Can you guess who has saved more? Correct, Nina. This is the power of compounding. The key is to start investing early, no matter how little the amount, and on a consistent basis. Investing in the stock market is the best way to grow your money in the long term. Once we understand that our money can work for us, it changes everything. Next, let's talk about what we can invest in. There are many types of assets you can use as investments. The most popular asset types are stocks and bonds. Stocks represent the ownership of a fraction of a company, also known as shares. This entitles the owner of a stock to a proportion of the company's assets and profits equal to how much stock they own. Bonds are like IOUs between investors and debt issuers, which can be companies or governments. The debt issuer promises to return the invested principal amount with a specific rate of return after X period of time to the investor. U.S. Treasury bonds are debt obligations issued and backed by the U.S. government. Because U.S. Treasuries are considered to be a risk-free asset, they generally offer lower yields relative to other bonds. These assets are then bought and sold on an exchange. The term stock market refers to the collection of exchanges. In the U.S., there are two main exchanges, which are the New York Stock Exchange and the NASDAQ. Exchange-traded funds, or ETFs, are just a basket of assets such as stocks. They often track a specific sector, such as healthcare, an underlying passive index like the S&P 500 that is made up of approximately 500 of the largest U.S. companies, or follow a thematic strategy like disruptive innovation. ETFs are also bought and sold on exchanges throughout the day just like stocks. Most ETFs have a management fee called an expense ratio, which is deducted annually from the fund. This fee can vary in cost based on if the fund is passive or actively managed. Investors will receive the total return of the ETF less the expenses. This brings us to rule number 3. Minimize fees and taxes. Fees add up over time, no matter the size. Let's look back at our example of Nina and Mark with their 10% annualized return, but this time with a 1% fee. As you can see, these fees kill your gains. It's like compounding in reverse. Just look at what's being left on the table. When using ETFs, lean towards ones with the lowest expense ratios. High-fee products do not equal high annual returns on a consistent basis. To minimize taxes, contribute to a tax-advantaged account like 401ks and IRAs before funding taxable accounts. Each type of asset class has a set of unique properties that make them different from each other. The unexpected changes in the growth rate of the economy or the level of inflation can influence how well an asset will perform over a given period of time. Let's take a quick look at these properties for stocks and bonds. Stocks perform best during times of accelerating economic growth. Bonds, on the other hand, perform better during periods of slowing economic growth. Bonds are often negatively correlated to stocks, so when one goes up, the other often tends to go down. But there are other cases where both assets will go down together, as we saw back in 2008. Periods of increased inflation benefit emerging country stocks over developed country stocks, while the opposite is true in increased deflationary periods. Since bond interest payments are fixed, their value can be eroded by inflation. The longer the term of a bond, the higher the inflation risk. On the other hand, bonds are a deflationary hedge. Deflation increases the value of the dollars that the bond investors get paid. I recommend watching How the Economic Machine Works by Ray Dalio. It provides a clear view on how economic cycles work. Investing involves risk, the risk of losing all of your capital. Often, the more risk you take, the higher the reward, but only you can make those decisions. Companies can go bankrupt and have their stock price go to zero. Rising interest rates can push bond prices down, or even worse, governments can devalue their currency. All investments have different types of risk. The more you understand them, the more you can manage them and become a better investor. Past investment performance does not guarantee future growth, but risk is guaranteed. This leads us to our next question. How much risk do you want to take? You can measure risk in many ways. I use standard deviation, which is the measure to which actual returns deviate from the average return over a certain period. In Rule 1, we define our time horizon and risk capacity. So let's get a better feel for how the sausage is made with asset allocation. Asset allocation is just what asset classes you're holding in your portfolio and how you're going to size those positions. We can use websites like portfoliovisualizer.com to take a deeper dive. Using historical data, we can look at what the annualized return was for a given asset over a period of time. We then use the annualized standard deviation to see what some of the potential risks are. Let's look at the Standard & Poor's S&P 500 ETF, ticker symbol SPY. It has a standard deviation of 15.63% and an annualized return of 9.07% over this time period. So using this data, 86% of the time, its yearly return could be as low as negative 6.56% or as high as 24.7%. Now let's take a look at the Vanguard Total Bond Market ETF, ticker symbol BND. Its standard deviation is 3.66% and has an annualized return of 4.27% over the same time period. Again, 68% of the time, its yearly return could be as low as 0.61% or as high as 7.93%. As you can see, we can use the standard deviation to estimate the likelihood of returns falling in within a range of possible outcomes. Let's try to look at it another way. Take Joseph. He decides to invest 100% in stocks at the beginning of his journey to reach his financial goals based on his risk capacity and time horizon. He starts out with $10,000 and invests in the S&P 500 ETF. Using standard deviation, we can estimate the worst case his balance drops to $6,218 by the end of the year. The best case, his balance will increase to $15,596. On the other side of the coin, we have Adam, who has a shallow risk capacity and has elected to invest 100% in bonds. He starts with $10,000 as well, but invested in the Vanguard Total Bond Market ETF. Adam's worst case is his portfolio drops to $9,323 by the end of the year. The best case, his balance increases to $11,525. Now fast forward, and Joseph is getting closer to his financial goal and wants to rebalance his portfolio to reduce his risk. He decides to allocate his updated balance of $31,000 to 50% in bonds and 50% in stocks. With this new asset allocation, Joseph has the potential to increase his portfolio to $42,038 by the end of the year, but could also see it fall to $24,098. You can see with just two assets in your portfolio how different your returns can be based on your allocation. Having the proper asset allocation is critical to reaching your goals and is why it's the most important investment decision. Next is rule number 4, diversify your portfolio. What's the saying? Don't put all your eggs in one basket. As we have covered, each asset type comes with its own level of risk. To mitigate that risk, we need to invest across multiple asset classes such as stocks, bonds, and real assets, and add another layer by investing across multiple countries as the economic environments for those countries will impact their returns. Investing in a U.S. company that collects international revenue is not the same. The holy grail of diversification is to further diversify within those assets with different uncorrelated types of stocks, bonds, and real assets. The more properly sized uncorrelated assets in a portfolio, the less volatile it will be, resulting in fewer portfolio drawdowns. Now don't go overboard. Try to limit yourself to a max of 30 positions. A more complex portfolio comes with more trades. More trades come with more cost of buying and selling positions. Try to use ETFs to simplify your holdings and reduce the number of positions in your portfolio. So how do you buy stocks? Well, to do that, you need a brokerage. There are a lot of choices available when it comes to selecting a brokerage. They all have their own pros and cons based on your needs. There is a link in the description with several reviews to pick from. I believe that the first thing one should look at are the management and commission fees, as those fees occur no matter the performance of your portfolio. Keeping these costs close to zero ensures that all your money is actually going into the market. Look for brokerages that have account minimums that meet your needs and will allow you to get started early. Find one that has the ability to automate your purchases in your investments, as we've talked about in rule number 2. For those reasons, I personally went with M1 Finance. Please know that this is not a sponsored video. They have provided me with a great user experience with a very clean and simple UI. Their platform was built from the ground up to allow the purchase of fractional shares of assets which allow you to put all your money to work. Let's say one share of a company stock that you want to invest in is currently priced at $1,000 and you only have $1 to invest. You will still be able to purchase 1/1000th of a share in that company. M1 Finance is also focused on long-term investments. They have limited trading windows, which removes the ability to actively day trade. Once you have selected a brokerage, it's time to open up an account. Most brokerages will offer several types of accounts. Here's a quick rundown. There are taxable accounts and tax advantage accounts that are commonly known as IRAs, which stands for Individual Retirement Agreements. IRAs come in 2 flavors, Roth and traditional. Since IRAs are solely for retirement, they come with a list of restrictions, which you can find in the description below. With the traditional IRA, you put money in that has not been taxed, and taxes are deferred until withdrawn in retirement. But with the Roth IRA, you put money in that has already been taxed, so there are no additional taxes on the gains when withdrawn in retirement. Unlike traditional IRAs, Roth IRAs have income limits for making contributions. With taxable accounts, you can buy and sell as much as you want, but will have to pay taxes on the gains. You should also look up pattern day trading rules and good faith violations, as breaking these rules can have an impact on your account. In terms of capital gains, as of 2021, you will pay long-term capital gains if you hold positions for more than a year and a day. Short-term capital gains will apply for any positions held less than a year. Dividends and bond interest are taxed as ordinary income within this account. Now for the next big question. How should you invest? There is the hands-free or passive view that takes the if you can't beat them, so join them approach. Basically, you can't beat the general market on a consistent basis, and the cost of trying to do so does more harm than good. So you should just buy and hold low-cost index funds. You will get the same returns that the market gives and don't have to stress over picking stocks. There are fewer trades with this type of investing, which reduces trading costs. It's simple. You're just holding a basket of transparent assets that don't require constant research and adjustment. You get the market returns for better or for worse and are free to focus on other things in life. Here is just a sample of an asset class universe that passive investors can choose from. We have developed market equities with U.S. and international funds, emerging market equities, U.S. bonds with different durations, and commodities and gold. The simplest thing you can do is buy and hold the Vanguard Total World Stock Index Fund, ticker symbol VT, which holds over 8,000 global stocks. Active investing, on the other hand, is where you're making bets on specific securities that you believe are undervalued and have the opportunity to beat the market. Active security selection does require additional time and research when constructing a portfolio. Also be mindful that even active professional fund managers have a difficult time consistently beating their passive benchmarks over long periods of time. You can check out the SPIVA study on the number of large cap funds that underperform the S&P 500. And lastly, rule number 5, find the investment strategy that works for you and stick with it. Investing for the long term can be hard, but you must remain disciplined to achieve your goals. Investing can trigger lots of emotions. Market drawdowns will make you feel like you're on a roller coaster and can cause you to exit positions at the worst times. Stay the course. The market can fluctuate from day to day. The best investment strategy is the one you can stick with. So there you have 5 basic rules on how to start investing. Define your risk capacity for your goals. Start early and pay yourself first. Try to minimize fees and taxes. Diversify your portfolio and stay the course. Here is how I applied these rules when I set up my taxable account. Back in 2019, I wanted to set up an account as a college fund for my newborn son. My risk capacity is high as I don't need the funds until he's graduated high school in another 16 plus years. Fingers crossed. I set up automatic deposits every week when I first started the account to dollar cost average into my portfolio. Dollar cost averaging means that you're regularly investing a fixed dollar amount into an investment. You purchase more shares when the prices are low and fewer shares when the prices rise. I then transitioned to only depositing at the first of the month. I did this to reduce fees because the more trading you do, the more cost you incur. I have provided a link with more details on dollar cost averaging versus lump sum deposits in the description below. I took time to research different asset allocation strategies until I found the one that worked for me. I also created rules to keep me focused on my long-term goals, which I also discussed in previous videos, along with how to avoid common investing mistakes. That's going to do it for this video. I wish you all the luck on your investing journey. In future videos, I'll be going more in depth on rules of several investment strategies and also provide an update on my portfolio. Cheers!